Welcome back to the Daily Hunt, your morning kickstart for market insights. It's Thursday, September 26th, and we've got a mountain of data to sift through today, don't we, Brooke?
We sure do, Ethan. There's quite a bit of chatter out there, with a good number of different stocks getting attention. We're seeing some really hot speculative plays, especially in the AI space, but also a few more traditional names. I'd say it's a mixed bag, some exciting potential, but definitely a lot of risk management to consider this morning.
All right, let's jump right into it. First up, Apple Inc., AAPL. Our AI-generated insights are picking up a bullish lean here, largely due to Apple's aggressive push into AI, integrating big models like Google's Gemini. Analysts are even lifting price targets to $280 for the iPhone 17 cycle. It seems like the market believes Apple is making the right moves to solidify its position.
Well, that's certainly the narrative, Ethan, but the KPIs tell a slightly different story for new investors. We're looking at a PE ratio of almost 39 and a current price flirting with its 52-week high of $260.01. While the AI news is compelling, that kind of valuation means a lot of future growth is already priced in. Plus, some of the user comments were focused on older iPhone models still being king, which, could signal less innovation appeal for upgrades. Given the valuation and debt to equity at 154%, for immediate new investment, I'd have to say stay away.
Fair point, Brooke. Next, let's talk Intel Corporation, INTC. There's a palpable excitement around Intel, particularly with whispers of Apple potentially investing, plus past partnerships with NVIDIA and government support. Our AI detected very bullish sentiment, with users reporting huge gains and projecting targets like $40 or even $100 a share. That's momentum.
It's certainly got the buzz, Ethan, and the stock is near its 52-week high, which supports those recent gains. But the fundamentals are frankly concerning. We're seeing negative net profit margins and negative EPS. The company is losing money and revenue growth is nearly stagnant at 0.2%. While the Apple talks are a big catalyst, investing purely on speculation when the core business isn't profitable and facing significant debt just screams high risk. My KPI decision here is a definite stay away.
Shifting gears to Advanced Micro Devices, AMD. A lot of folks are feeling like they're back in the game with AMD. Jim Cramer's even put it on his buy now list, and we're seeing traction in the AI infrastructure market with new partnerships. That's a company with serious growth engines.
Ethan, the community chatter around AMD is pretty split, leaning bearish actually. The top comment noted 0% growth in 7 years, and Cathie Wood's ARK Invest just sold off $22 million worth of stock. When we look at the KPIs, a negative operating margin, meaning they're losing money on core operations, paired with an extremely high debt to equity of 6.5 and a PE nearing 96, that's incredibly risky for new money. So for AMD, it's a stay away.
Okay, a slightly odd one now. Pintech Technology Holdings, PIT. There was some buzz around PT, though a lot of it was actually for a different biotech company called PEPG. But for Pintech itself, the news did highlight their unaudited financial results and a private placement. Could be a turnaround play, right?
Well, the confusion itself is a red flag, Ethan. And when we do look at Pintech's actual KPIs, it's even redder. We're talking about a negative price-to-book ratio, meaning liabilities exceed assets, plus consistently negative profit margins across the board and extremely low revenue growth. This isn't just risky, it suggests fundamental distress. Absolutely a stay away from Pintech.
Let's move to Amazon, AMZN. We had some mixed sentiment initially, but a more recent post on Amazon had a very bullish YOLO vibe, with users confident in its long-term potential, especially with its AI initiatives. Analysts are maintaining market outperform ratings, and the fundamentals are strong. 13.3% revenue growth and 24.77% ROE.
I agree the recent sentiment is bullish, Ethan, and those revenue growth and ROE figures are impressive, Ethan. But that first post did highlight some losing money sentiment, potentially from those who bought at its 52-week high of $242.52. And the $2.5 billion FTC settlement, while resolved, isn't exactly a growth catalyst. However, the overall financial health is solid, and its AI investments are real. For long-term growth, this is a buy.
Next, International Business Machines, IBM. This one is really interesting. Our insights show strong bullishness. IBM's quantum computing breakthroughs, particularly with HSBC trialing quantum-enabled bond trading, are huge. The stock has been printing stacks, as one user put it, and it's near its 52-week high.
You know, Ethan, that quantum news is definitely exciting, and the stock's recent performance validates the hype. But for a traditionally mature company, a PE ratio of almost 45 is quite high, suggesting a lot of future potential is baked into the price already. Revenue growth is only 7.7%, so the valuation hinges heavily on these future quantum leaps. Still, the breakthrough is significant. This one leans to a buy, but be aware of that valuation.
Now Nebius Group, NBIS. The community is absolutely ecstatic about NBIS. We're talking you crazy son of a bitch, I'm in level enthusiasm. Major partnerships with Microsoft and NVIDIA are being cited, robust AI cloud growth, and analyst price targets reaching $206. It's a high flyer.
Oh, Ethan, the user sentiment for NBIS is incredibly bullish, almost overwhelmingly so. But my KPIs are flashing bright red. An astronomical debt-to-equity of over 32, a PE of 147, and negative operating margins. The company is deeply unprofitable and highly leveraged. The claims of net cash in the posts contradict the financial data entirely. This is pure speculation and extremely high risk. Definitely a stay away.
Let's look at Alphabet, Google. Despite some attempts to paint it as a loser, our AI insights show overwhelming bullish sentiment. Users are laughing at the idea of losing money on Google, emphasizing its reliability as an investment. Plus, we've got strong revenue growth, phenomenal net profit margins, and Baird just raised the price target.
Absolutely, Ethan. The community clearly believes in Google, and the KPIs back it up. A net profit margin over 31% and an ROE of nearly 35% are just incredible for a company of its scale. Even with some EU antitrust fines looming, these are fundamental powerhouses. The slight concern on a debt-to-equity of 11.481 is overshadowed by its profitability and growth. This is a solid buy.
How about Crocs, CROX? One user went full port on margin into it. That's conviction, right? Maybe a contrarian play.
A full port margin play, Ethan, that's a massive gamble. The overall sentiment is actually very bearish, with the stock near its 52-week low. Analysts like Piper Sandler have downgraded it to neutral, slashing price targets. Plus, that debt-to-equity ratio is a staggering 124.8. That's immense financial risk. For CROX, it's a hard stay away.
Moving to the automotive retail space, CarMax, KMX. Any diamonds in the rough here?
Unfortunately, no, Ethan. The sentiment around CarMax is overwhelmingly bearish. The company has repeatedly missed earnings, and Wedgebush just downgraded it, cutting their price target from $64 to $54. The stock is practically at its 52-week low, and the debt-to-equity ratio is an alarming 309.9. This is a clear stay away.
What about Oklo Inc., OKLO, the nuclear tech company? One user even called it a winner in their recent trades, and it's had massive year-to-date gains.
While it's certainly seen a run-up, Ethan, the broader sentiment from the community is quite skeptical, and for good reason. Oklo is currently unprofitable with negative EPS and a 0 net profit margin. Its price-to-book ratio is an extremely high 25, suggesting massive overvaluation for a non-profitable company. Even Goldman Sachs initiated coverage with a neutral rating and a target below its current price. This is a definitive stay away.
Let's talk Costco Wholesale Corporation, COS. A lot of stability there, right? Strong Q4 earnings, robust sales, a safe bet?
It's certainly a strong company, Ethan, but the question was about going full port at the close, which the poster framed very cautiously. While Costco has solid fundamentals, its PE ratio is over 53 and its PB is over 15. That's a very rich valuation, especially with a debt-to-equity of 30.8. For a highly aggressive entry, the upside is likely limited at that price point. My take is stay away for that kind of speculative high concentration play.
Finally, Snap Inc., SNAP. We've got comments about its massive youth user base and long-term monetization potential. Could it be time for a rebound?
Snap definitely has that loyal user base, Ethan, which users are optimistic about. But financially, it's still struggling. We're seeing negative net profit margins, negative EPS, and a truly staggering debt-to-equity of over 202. Though it's down from its 52-week high, that PB is still high for a company losing money. It's too risky for now.
Stay away. All right, that was a lot to digest. For those of you looking to dive deeper, here are our top candidates from today's hunt.
Remember, these are AI-generated insights and market commentary to help focus your own research.
Investigate as buy. Alphabet Inc., Google, Amazon.com, AMN. Investigate as cautious buy. International Business Machines Corporation, IBM. Investigate as speculative gamble. Nebius Group, NBIS. That wraps up another edition of the Daily Hunt.
This podcast is for informational and entertainment purposes.